So today I'm going to talk about the difference between a whole life policy and an index universal life policy. So the first question is, what's the difference? A whole life policy, the level or the cost of insurance is level, meaning that they're going to determine how much does it cost to insure you from today until mortality. And typically insurance companies will go 100 years old or 121 years old, and then they're just going to divide that cost out equally throughout the years. So your cost of insurance is going to be level every year. And then your cash value, the portion of your policy that grows and builds, is not pegged to any index. So your cash value is going to grow in accordance to the interest rate that the insurance is willing to offer you, as well as the profitability of the insurance company, assuming it's a mutual life insurance company. Whereas an index universal life, the cost of insurance increases every year. It's built upon a 1-year renewable term policy. So what that means is this year it's going to cost a certain amount to insure you. Next year, when you are a little bit older, it's going to cost you a little bit more to insure you. So every year that's going to go up. And then the cash value portion is pegged to an index. So if the index goes up, your cash value will rise. If the index goes down, your cash value is not going to rise. So when you look at it from a graphical standpoint, this is what it looks like. The whole life policy, the cost of insurance, as I said, is level. So every year you pay the exact same amount of insurance because they've figured out how much is it going to cost to insure you over time. And they've divided that equally. Your death benefit increases over time. So the longer these policies are in place, the more efficient they become. The more efficient they become, the higher your death benefit is, as well as your cash value will continue to increase every year. So your cash value is going to grow every year as well. And then at policy maturity, either 100 years or 121 years old, your cash value and your death benefit should equal. They should be the same. When you look at an index universal life policy, the cost of insurance is increasing. So again, this goes back to it's built upon a 1-year renewable term rider. So it's going to cost more to insure you today than it would cost to insure you. It's going to cost less to insure you today than it's going to cost to insure you next year and then the following year. So every year that cost of insurance is going to go up. Oftentimes, the death benefit on these types of policies is flat, so that death benefit just stays level. There are some policies, into IUL policies, in which the death benefit will increase, but most times that death benefit just stays flat. So what happens here with the cash value? The cash value is going to increase over time, but what happens is there's only 2 ways for that cash value to continue to increase. Either 1, the index continues to perform, or 2, you pay more than the minimum amount that is required to keep the policy in force. So you overfund the policy. Because what happens is that cost of insurance is rising. And with that cost of insurance rising, the cash value is also rising. But if it ever gets to the point where your premium is not covering the cost of insurance, which happens, it'll start to use the cash value to supplement that premium payment. And then what will happen is that as that cost of insurance continues to rise, that cash value is getting chewed up to where eventually that cash value will just continue to decline and go to zero. And when that happens, the policy itself collapses. So this is why you've seen, if you just do a quick Google research, you'll see lawsuits against insurance companies with these universal policies. Because people have paid into them for 20, 30 years, and at the age of 75, when they can't get insured, they think they have permanent insurance, and they get a letter in the mail that says, hey, unless you pay X amount of dollars, your policy is going to go away. So they have to either pay these exorbitant amounts of money to keep their policy in force, or the policy is going to collapse. So when you think about insurance, what you're trying to do is transfer risk, right? I'm trying to transfer the risk of me dying to the insurance company. That's what a whole life policy does. Whereas an index universal life policy, I still retain some of that risk. The insurance company takes some risk, but I'm retaining some risk as well because there's a high likelihood, unless I'm overfunding that policy all the time, that my cash value is going to collapse and therefore my policy itself is going to collapse. So either the index has to continue to rise or I have to overfund it in order to keep up with those costs of insurance increasing. So I hope that helps, and we'll talk to you next time. Thanks for watching.